All right, so we got a pretty hefty stack here, all about funding a new business.
Wow. Yeah.
Looks like we've got articles, excerpts, even some chapters from Funding a New Business for Dummies.
Someone's doing their homework.
You're definitely ready to tackle this funding thing, and we're here to make sure, well, you're not going in blind. We'll break down the options, figure out what works for you, and who knows, maybe we'll uncover some strategies you hadn't even thought of.
It's a whole different world out there compared to, even a few years ago. Bootstrapping used to be the main thing, but now you've got angel investors, venture capital, crowdfunding.
It's a lot to take in,
Uh-huh.
and I can see how it'd be easy to get lost in all the terms and different paths.
Right.
So let's back up for a sec. Why does a startup even need funding?
Good point.
What are the absolute must-haves?
Well, you've got marketing to get the word out, finding the right people, talent, and then, of course, developing your product or service.
That makes sense.
And don't forget, just keeping the lights on, all those operational costs.
It all adds up.
It really does. And beyond just surviving, funding is about reaching your goals, growing, making that vision a reality.
Right.
Take Beyond Meat, for example. They bootstrapped in the beginning, really scrappy.
Mm.
But things changed big time when Kleiner Perkins, the venture capital firm, invested back in 2011.
I remember that, yeah.
It's fascinating how Kleiner Perkins saw their potential.
Was it disrupting the meat industry?
Exactly. They had this history of backing companies that, shake things up. And that funding, well, it let Beyond Meat meet the demand for plant-based alternatives, and boom, they're worth billions now.
Talk about a success story.
It is.
It shows how the right funding can be a game changer. And speaking of changing the game, look at Stripe.
Oh, yeah. They're incredible.
Started in 2010, laser-focused on fixing online payments.
A real problem at the time.
Huge problem. They've raised over $2 billion in funding through different rounds.
Wow.
And now they're valued at, around $50 billion?
It's mind-blowing. What's interesting is that both Beyond Meat and Stripe, they took different paths to success.
Yeah.
But it just goes to show there's no one-size-fits-all solution when it comes to funding. It depends on so many things. What you're aiming for, your risk tolerance, even your personal values.
It's not just about getting the money, but getting the right money from the right source.
Right.
Now, this Funding for Dummies book you sent, it breaks down funding into stages. You've got the idea, startup, growth, expansion, and finally exit.
Makes sense.
It seems like matching your funding source to where you are in your business is crucial, especially in those early stages.
Oh, absolutely. Imagine you're in the idea phase, excitement's high, but you need money to test it, build a prototype.
Right.
This is where angel investors come in, or even crowdfunding. They're looking for potential, even before there's a finished product.
So you've got your prototype, maybe some early customers,
Yeah.
and you're moving into the startup phase. Now you need more. For marketing, expanding your team,
Yeah.
bigger production runs. Is this where those venture capital firms, the ones with the deep pockets, come in?
Often, yes. They're looking for fast growth, potential to really scale up, and they're willing to invest big to make that happen. But, and this is a big but, they're taking a piece of your company in return.
That equity stake, I think that's what makes a lot of founders hesitate. They want the money, but don't want to lose control.
Right.
Have you seen cases where companies say no to VC money to stay in control, even if it means slower growth?
Oh, definitely. Some founders are very protective of their vision.
Makes sense.
They'd rather grow organically, even if it takes longer. It's a tough choice, weighing potential for massive growth against the freedom to do things your way. It all boils down to priorities and how much risk you're comfortable with.
It's a balancing act.
Yeah.
All right, so you make it through the startup phase, you're growing like crazy.
Exciting times.
New markets, more customers, you need even more fuel for that growth. What are the options at this stage?
This is typically where Series A funding comes in, often led by a VC firm.
Hmm.
It's a big investment, meant to help you hit those major milestones and really expand your reach.
And then you're on to the expansion phase. You're a major player, maybe looking at acquisitions, new product lines, going global even.
Right, and that might mean Series B, C, or even later funding rounds. You might be looking at a mix of equity and debt financing, depending on, well, your specific situation and goals.
And finally, the exit, the culmination of all the hard work. This is where you might go public with an IPO or get acquired by a larger company.
Yeah.
I imagine your funding strategy here is all about maximizing returns for everyone involved.
Exactly. The exit is the destination, but the journey to get there, it can be quite a ride. But before we get ahead of ourselves, let's go back to the beginning.
Okay.
To bootstrapping, the do-it-yourself approach. Not every startup needs to chase big investments right away.
Bootstrapping. I love that word. It's about resourcefulness, starting with what you have, making every dollar count.
It is. It's about growing responsibly, staying lean, and focusing on making a profit from day one.
Less is more, kind of.
Exactly. This Dummies book actually gives some great tips for keeping those early expenses down, like adopting a lean operating model, being smart about outsourcing, negotiating for discounts, and using those free resources, like Google Docs.
It's like Marie Kondoing your expenses, getting
Yeah.
rid of anything that doesn't spark joy, or at least doesn't directly help your bottom line.
Love that analogy.
And look at Basecamp. They're a great example of bootstrapping done right.
Oh, they're fantastic.
They solved a real problem for businesses, kept their team small, and prioritized profits from the very beginning.
They show that you can build a successful company without giving away equity, without losing control, staying true to your vision, and creating a product people genuinely want.
Inspiring. It's a good reminder that sometimes the best funding strategy is building a solid base, making money from the start. But of course, bootstrapping isn't for everyone. Some businesses need a significant investment up front, and that's where things like debt funding come in.
Right. Debt can be a powerful tool if you use it wisely. But you really have to understand the terms and the risks before you jump in.
Debt. I think a lot of people, especially new entrepreneurs, hear that word and get nervous.
Oh, I understand that.
Can you break it down for us?
Sure.
Like, what are the key terms we need to know? Interest rates, principal, collateral, amortization, and maybe help us get over those debt anxieties.
Absolutely. First off, let's acknowledge the anxiety. Debt is a big decision. Nobody wants to be crushed by loans or risk losing their personal belongings.
Of course not.
But debt can also help you grow, especially if you're strategic about it.
So how can debt be used strategically? What are the biggest mistakes you see people making?
Well, it all comes down to understanding those key terms. Let's start with principal. That's just the amount you borrow initially. Then you have interest, the cost of borrowing. It's usually a percentage.
Right.
So if you borrow $10,000 at a 5% interest rate, you'll pay back the $10,000 plus $500 in interest for that year.
Okay, makes sense. What about amortization? I hear that one a lot.
That's just spreading out your loan repayments over time. So instead of one big lump sum, you make smaller, more manageable payments, usually monthly.
Ah, so it's more digestible.
Exactly. Now, collateral, this is something lenders might ask for, especially for bigger loans. It's basically an asset you promise to the lender as security. If you can't pay back the loan, they can take that asset to cover their losses.
That's where the anxiety kicks in. Right, you're putting something valuable on the line.
Exactly. And that's why you have to think carefully about personal guarantees. That's when you, the business owner, personally promise to repay the loan, even if your business can't. It means your personal stuff could be at risk, not a decision to take lightly.
So how do you know if taking on debt is the right move?
A few things to consider. First, be crystal clear about why you need the money. How does it fit into your overall strategy? Don't take on debt just because you can. Make sure it has a purpose. Next, shop around. Compare rates and terms from different lenders. Don't just take the first offer.
So treat it like any other big business decision. Do your homework.
Exactly. And be realistic about your ability to repay. Don't overextend yourself, especially early on. Have a solid financial plan that includes those debt repayments, and think about what if. What if your revenue is lower than you expect? Have a backup plan.
Great advice, and I think that applies to any type of funding, not just debt. Now let's switch gears and talk about equity funding, where you trade ownership in your company for capital. This is where things get a little more complex, right?
It can seem that way, but it's not as scary as it sounds. You're essentially sharing a piece of your pie, a share of ownership with investors in exchange for their money. They'll have some say in how your business is run, and their return depends on how well your company does.
So they're not just passive investors, they're partners, really.
Exactly. They're invested in your success. Now, the book you sent talks about equity dilution, which can be a tricky concept. Imagine you own 100% of your company, right?
Okay.
You bring in an angel investor. They put in, say, $100,000 for 20% equity. After their investment, you own 80% and they own 20%. That's equity dilution. Each time you raise more money through equity, your ownership shrinks a little.
So it's a trade-off. You get the money you need to grow, but you give up some control. The question is, how much control are you willing to let go of?
Exactly. And that's a personal decision, weighing the benefits against the potential downsides. When it comes to equity funding, you have a few main options, each with its own pros and cons. Angel investors, venture capitalists, and crowdfunding.
Okay, let's unpack each of those. What makes them different, and how do you know which one is right for you?
Let's start with angel investors. These are individuals, usually with a lot of wealth, who invest their own money in early-stage companies. They often have experience as entrepreneurs themselves.
They've been there, done that.
Exactly. They're often driven by a passion for supporting innovation, taking risks on companies that traditional lenders or VCs might shy away from.
So it's not just about making a profit. It's about supporting ideas they believe in.
Right. They're looking for companies that align with their values, their interests. Plus, they often bring more than just money.
Hmm.
Mentorship, guidance, valuable advice from someone who's been in the trenches, that can be priceless for a new business.
So for someone just starting out, finding an angel investor could mean funding a mentor. That's a great combo. And what about venture capitalists? They seem to be the big players in the startup world.
They are. Venture capitalists are professional investors, managing big pools of money from different sources.
Pension funds, endowments, that sort of thing.
Exactly. They're looking for businesses with the potential for high growth. And they usually invest later on when a company has proven itself and is ready to scale up quickly.
So they come in with the big checks, but they expect big returns too.
Right. They're looking for businesses that can multiply their investment, and they're willing to take on more risk to make that happen.
And since they're managing other people's money, they're usually more strict with their due diligence, more selective about who they invest in.
Absolutely. They want to see a well-managed business, a good track record, a clear path to making a profit.
So for a company that's already gaining traction, ready to grow fast, a venture capitalist could be the perfect partner.
But what about crowdfunding? That seems to be a popular option these days, especially for businesses with a strong community following.
Crowdfunding has definitely become a viable option.
Yeah.
It lets you tap into the power of the crowd, raising money from a large number of individuals, often through online platforms.
It's like democratizing the funding process.
Exactly. It opens doors for businesses that might not fit the traditional model for angel investors or VCs. So we've got angel investors, VCs, and crowdfunding. Each one seems to fit a different stage of business with different levels of risk and control involved. What are some key questions an entrepreneur should ask themselves when deciding which path to pursue?
Great question. The first one is, how much control are you willing to give up?
Right.
Angel investors and VCs will want a say in how you run things. Crowdfunding lets you keep more control.
Makes sense.
Then, how much money do you actually need? Crowdfunding's good for smaller amounts, while VCs handle those larger investments.
And your own risk tolerance is a factor too, right?
Absolutely. VCs and angel investors are taking a bet on you, and they expect significant returns.
High stakes.
They are. And don't forget the time and effort involved. Crowdfunding takes a lot of work to manage a successful campaign, while getting funding from angels or VCs can be a long, complex process.
Okay, so you've identified potential investors. You know which type you want to approach.
Right.
What's next? How do you negotiate a deal? And what are the pitfalls to watch out for?
Well, remember, it's a negotiation, not a dictatorship.
Right.
Both sides are trying to get the best deal. Be ready to walk away if the terms aren't good for you.
So stand up for yourself and what you believe in.
Exactly. Now, the term sheet, that's essentially the blueprint for the investment agreement.
I'm always intimidated by those legal documents. Can you break it down for us non-lawyers?
Of course, valuation, that's one of the most important terms. It's the agreed upon worth of your company. A higher valuation means you give up less equity for the same amount of money. Then there's liquidation preference, which decides who gets paid first if the company is sold or, well, goes bankrupt. Usually investors get their money back first, then whatever's left is split among the shareholders.
So it's about protecting the investor's money. What about protective provisions? I've heard that term thrown around.
Protective provisions give investors certain rights, some control over the company. They might have the right to approve big decisions, like issuing more stock or selling the company. It's a way for them to protect their investment and have a say in important matters.
Makes sense. So you've hammered out the terms. You're ready to move forward.
Okay.
What happens during due diligence, and what should you expect?
Due diligence is when the investor takes a deep dive into your business. They'll verify all your claims, go over your finances, check your market potential, even talk to your customers.
Like getting your house inspected before selling it.
Exactly. They're kicking the tires, making sure everything is as you said it was.
So how do you ace due diligence?
Preparation is key. Get your financial records organized, have an updated business plan, and be ready for tough questions about your strategy. And most importantly, be transparent. Don't try to hide anything. If there are weaknesses, address them head on.
Honesty is the best policy.
Absolutely. And it's not just about the paperwork. Be ready to showcase your team, their expertise, their passion, their commitment. Remember, investors are investing in people as much as ideas.
You're betting on the people who will make it happen. That's a great point. All right, so you've been through due diligence. Everything looks good. The deal is done. The money's in the bank.
Congratulations.
What happens next?
First, celebrate. Closing a funding round is a huge accomplishment. Then the real work begins. It's time to use that capital, put your plan into action, and start hitting those milestones.
And I imagine keeping a good relationship with your investors is crucial now.
Absolutely. They're your partners now. Building a strong relationship based on trust, communication, shared goals, that's essential for success.
So it's not just about the money. It's about the partnership and the value they bring beyond the capital. What are some tips for building a healthy investor relationship?
The book stresses communication, being open, and mutual respect. Keep your investors in the loop about your progress, good and bad. Be honest about any hurdles or setbacks.
So no sugarcoating.
Exactly. Honesty builds trust. And remember, your investors have a wealth of experience. They've been there. Don't be afraid to ask for advice. Tap into their expertise.
They're like a board of advisors who are financially invested in your success.
That's a great way to put it. A strong investor relationship can be a huge advantage for your business. Their support can go beyond just funding. They can open doors, connect you with the right people, and give you strategic guidance that can help you navigate the ups and downs of entrepreneurship. And that support can be especially helpful when considering some of the more alternative funding options out there.
That's a perfect segue into the next part of our deep dive. We've covered a lot here with bootstrapping, debt, and equity funding, but as we've seen, there's a whole world of alternative funding options out there. So let's take a break, and when we come back, we'll explore those options, including grants, subsidies, and even dive deeper into crowdfunding.
So ready to dive into some of these alternative funding options, where to find that free money everyone's always talking about.
Let's talk grants. I have to admit, the idea of free money is pretty tempting.
I get it.
This Funding for Dummies book has a whole chapter on finding grants, and it covers everything. Government agencies, private foundations, corporations, even tax credits and export support programs.
It's a lot to sift through. What's important to remember is that grants often come with strings attached.
Oh, like what?
Specific requirements, reporting obligations. It's not just filling out a form and cashing a check.
Ah, so there's work involved.
Definitely.
Yeah.
You need to show that your business fits with the grant's goals and that you have a solid plan for using the money effectively.
So not exactly free money then.
Not quite. It's more like a partnership. You're both working towards a shared goal, but the payoff can be huge. Funding you don't have to repay, no giving up equity, no taking on debt.
I can see the appeal, especially for entrepreneurs who are passionate about a cause or working in fields like, say, renewable energy or social impact.
Absolutely. And speaking of reducing costs, subsidies are another avenue worth exploring.
Subsidies.
Yeah. They can be a big help for businesses in certain industries or locations. Governments often offer them to boost economic growth or to support businesses that align with their policies.
Reading through this book, I was surprised by how many types of businesses can get subsidies. Everything from renewable energy projects to agriculture to historic preservation.
The range is pretty wide.
Definitely worth checking if your business might qualify. Now let's circle back to crowdfunding. We touched on it earlier as equity funding, but it's so different from traditional funding, it deserves its own spotlight.
I agree.
I think a lot of people are curious about crowdfunding, but aren't sure how it works or if it's right for them.
Right. Well, this Dummies book breaks it down nicely. It explains different types of crowdfunding, like rewards-based, where backers get products or perks for their contribution, equity crowdfunding, where they get actual ownership shares, and even debt crowdfunding, where you're essentially borrowing money from a crowd and repay it with interest.
So many options. It's like choose your own adventure, funding edition.
It is. But with so many choices, how do you pick the right model?
That's the million-dollar question.
It comes down to what you're trying to achieve. Rewards-based crowdfunding can be great for testing a product idea, building a community of early supporters. Think pre-selling a new gadget or offering exclusive merch to your backers.
But that means you have to actually deliver on those rewards, right?
Absolutely. You need to be ready to handle production, shipping, all of that.
So it's not just collecting money and then poof.
Nope. You're making a promise to your backers, and transparency is key every step of the way. Now, equity crowdfunding, that's more like traditional equity funding, but you're raising capital from a larger pool of smaller investors.
Instead of a few big VCs, you've got a crowd of investors.
Exactly. It can be a good fit for businesses that have a strong community following or a product with a niche appeal.
It's a way to really involve your audience and build a loyal base of investors who are excited about what you're doing.
Exactly. And then you've got debt crowdfunding, which is essentially peer-to-peer lending. You borrow from a bunch of people and pay them back with interest, usually over a set time.
So it's like a group loan.
In a way, yes. It can be a more flexible and accessible way to get debt financing.
It sounds like it could be a good fit for businesses that are making money but maybe aren't ready for a traditional bank loan or venture capital.
Right. So let's say you've decided to go the crowdfunding route. How do you pick the right platform? There are tons out there, each with its own rules and fees.
It can feel like a jungle.
It can. The book lists several popular platforms like Kickstarter, Indiegogo, Crowdcube, and Seedrs. They each cater to different types of businesses and crowdfunding models.
So Kickstarter might be good for, say, creative projects and product launches, while Indiegogo might be better for tech gadgets or social impact initiatives.
You got it. Platforms like Crowdcube and Seedrs focus on equity crowdfunding, connecting businesses with investors who want ownership stakes.
So much to consider. It seems like research is key. You need to really understand each platform, their audience, their fees, before you make a decision.
Absolutely. And just like any other funding approach, crowdfunding needs a solid strategy. You need a compelling pitch, eye-catching visuals, a clear financial plan, and a marketing strategy to reach potential backers.
So it's not just throwing your project up on a platform and crossing your fingers.
Nope. You have to treat it like a full-on marketing campaign.
Got it. Build excitement, get people talking, clearly explain your vision, and offer rewards or investment opportunities that resonate with your audience.
Exactly. You want people to feel like they're part of something bigger, that they're contributing to a shared vision.
I can see how that sense of community can be especially valuable in the early stages when you're building your brand and trying to get noticed.
It's huge. But it's important to remember crowdfunding isn't a magic solution. It takes hard work, dedication, and flexibility.
And like any funding source, it has its own challenges. Platform fees, regulations, disclosure obligations, and even the potential for public scrutiny.
All true. And don't forget the logistics. Fulfilling rewards, managing investor relations, and navigating the complexities of equity ownership.
Sounds a lot to juggle.
It can be. So it's crucial to go into it with your eyes wide open, have a solid plan, and be ready to adjust as you go. But beyond crowdfunding, we also have incubators and accelerators. Have you looked into those at all?
I've heard the terms, but I'm a little fuzzy on the difference. Can you explain what each one does and why they might be a good option for some entrepreneurs?
Sure. Both incubators and accelerators help startups, but their approaches are different. Incubators are like nurturing spaces, providing a supportive environment, mentorship, and often co-working spaces to help early-stage businesses get off the ground.
So they're a good option for someone who's just starting out, needs guidance and support.
Exactly. It's a safe space to try things out, learn, connect with other entrepreneurs.
I like that.
Now, accelerators are more intense, like boot camps. They're designed to help businesses scale up rapidly, achieve big milestones quickly. They typically offer intense mentoring, access to investors, and a structured program focused on growth strategies.
So if you're ready to hit the gas and accelerate your growth, an accelerator could be the ticket. But I bet getting into a good accelerator program is tough.
It is. They're very selective, and they usually take a small equity stake in return for their support. But the benefits can be huge. Access to resources, mentorship from experienced people, a network of potential partners and customers.
It's like a stamp of approval that can really open doors.
That's a great way to put it. And it's not just about the practical stuff. Accelerators offer a sense of community, peer support. You're surrounded by other entrepreneurs going through the same things, sharing advice, encouragement, all of that.
That's invaluable. So whether you're just starting out or you're ready to scale up, incubators and accelerators can play a key role.
They can. And the important thing is finding the right fit, a program that aligns with your needs and goals.
Do your research, network, make sure their culture and focus match your business and your style.
Couldn't have said it better myself. Now, let's shift gears a bit and talk about investor relations. It's not just about getting that initial check. It's about building a strong, lasting partnership.
It's easy to get caught up in the fundraising frenzy and forget about the relationship aspect.
Right.
But as you said, it's a partnership. And good partnerships are built on communication, trust, mutual respect.
Absolutely. The book really emphasizes that. Ongoing communication, transparency, mutual respect. Keep your investors updated on your progress, good and bad. Be honest about challenges and don't be afraid to ask for advice.
So lean on their expertise.
Exactly. They're more than just money. They're partners who bring valuable experience, connections, and strategic insights. Leveraging their knowledge can make a huge difference in your business.
It's like having a team of seasoned advisors in your corner rooting for your success.
Exactly. They've been there, made mistakes, celebrated wins. Their insights can be invaluable. And beyond their experience, they often have extensive networks that can open doors to potential partners, customers, even future investors.
So it's about tapping into their network, not just their checkbook.
Precisely. And that's why a strong relationship is so important. It goes beyond sending quarterly reports. Be proactive, communicate regularly, involve them in strategic decisions.
So how do you actually cultivate that kind of relationship? What are some practical things you can do?
Well, the book gives some great advice. Set clear expectations from the start. Be transparent about your goals and challenges, and schedule regular updates, whether it's through emails, phone calls, or in-person meetings.
So don't just wait for them to reach out. Take the initiative to keep them in the loop.
Exactly. And don't hesitate to ask for their advice. They're there to support you, and they often have valuable insights that can help you make better decisions.
But treat them like partners, not just ATMs.
Precisely. And it's not just about the business side of things. Share your company culture, celebrate milestones, invite them to company events. It's about building a personal connection, a shared sense of purpose.
I like that. It humanizes the relationship.
It does. And when you have that strong relationship, they're more likely to support you during tough times, open doors for you, and become advocates for your business.
Everyone wins. Speaking of winning, let's talk about how to actually get the funding in the first place. We've discussed all these options, but ultimately it comes down to being prepared and making a compelling case to potential investors, right?
You're absolutely right. No matter which funding route you choose, being prepared is non-negotiable. And that starts with a solid business plan.
Okay, let's talk business plans. They're often seen as the foundation of a successful business, but I think a lot of people struggle with writing them.
It's a common challenge.
What are the key elements of a strong business plan, and how do you make it stand out?
Well, the Dummies book has some really good advice on this. It stresses the importance of clearly explaining your business idea and the problem you're solving.
So it's not just about describing your product or service.
Yeah.
It's about explaining why it matters and how it addresses a real need.
Precisely. Paint a picture of the problem and why your solution is the answer.
It's about telling a story, isn't it?
It is. You're not just presenting facts and figures. You're weaving a narrative that draws the reader in and makes them care.
And that story needs to be backed up by research analysis,
Well,
right?
of course. Show them you understand your target market, your competition, the whole industry landscape.
So you're proving you've done your homework. You're not just throwing darts in the dark.
Right. And that includes a clear financial plan, revenue projections, expenses, your path to profitability.
The numbers have to make sense.
They do. Investors want to see that you understand your financials, that your growth projections are realistic. And don't forget about your team. Showcase their expertise, their experience, their ability to execute the plan. Investors are investing in people as much as ideas.
It's about having the right people to make the vision a reality.
Exactly. Now, beyond the business plan itself, your pitch is crucial. Whether it's to angel investors, VCs, or a crowdfunding audience, you need to grab their attention and make them want to be part of your journey.
So it's showtime. Any tips for creating a pitch that really resonates and makes an impact?
The book highlights keeping it concise, laser-focused. You don't have much time, so don't try to cram everything in. Focus on the key points: the problem, your solution, your target market, what makes you different, your financial projections, and tell your story with passion. Let your enthusiasm shine through.
It's not just what you say, it's how you say it.
Absolutely. Investors are drawn to passionate entrepreneurs, people who believe in what they're doing. They want to see that spark.
And being able to handle tough questions is important too, right? And investors are going to test your assumptions, try to find weaknesses.
Of course. Be ready for those tough questions, have thoughtful answers, and be honest. Don't try to hide anything.
Transparency again.
It's key. Think of it like a job interview. You're selling yourself and your vision, but you also need to be ready to answer tough questions and show your expertise.
And just like a job interview, preparation is key. Practice, rehearse, get feedback. And most importantly, believe in yourself and your vision.
I love that. Now, we've covered a lot, but let's step back for a moment and acknowledge that the funding landscape is always changing. What works today might not work tomorrow.
Right, it's a moving target.
It is. As entrepreneurs, we need to be flexible, willing to adapt, and keep learning. What are your thoughts on that?
It's all about staying informed about new trends, new models, attend events, read industry publications, network with other entrepreneurs and investors, keep your finger on the pulse, be open to new possibilities. What are some emerging trends in funding that stand out to you?
Well, one that's really interesting is impact investing,
Oh, yeah.
where investors are looking for businesses that not only make money, but also make a positive impact on the world, you know?
Social or environmental, right.
Exactly. It's not just about profits anymore. It's about aligning your business with values, making a difference.
I've definitely noticed that shift, too.
Yeah.
It's great to see investors supporting purpose-driven businesses, and it seems like consumers are also becoming more conscious about where they spend their money.
Oh, absolutely. Consumers are really paying attention now, and businesses that show they care about sustainability, ethical practices, being socially responsible.
That gives them an edge.
A big edge. And from a funding perspective, this trend opens up new doors for businesses that are tackling social or environmental challenges. Investors are realizing these businesses can be both profitable and impactful, good for the world.
It's like a win-win.
Exactly. Investors get returns, and we all benefit from innovative solutions to these big problems.
I like that.
We're also seeing these new financing models popping up, like revenue-based financing.
Revenue-based? What's that?
It's where investors get a percentage of a company's revenue until their investment is paid back.
Interesting.
It can be more flexible than traditional loans because repayments are tied to how well the company is doing.
So if your business is growing fast and you're generating good revenue,
It could be a great option.
yeah, get the capital you need without giving up equity or being stuck with fixed loan payments.
Right. And it can be especially attractive for businesses that have strong revenue but maybe haven't been around long enough for a traditional loan.
It's fascinating how the funding landscape is adapting to support this new generation of businesses.
It is.
Speaking of support, we've covered a lot about different funding types, but let's focus on you, the entrepreneur, and what you can do to boost your chances of getting funded.
Okay.
Your Funding for Dummies book has a great section called The Part of Tens, and one of those lists is all about maximizing your success when pitching to investors.
Oh, yeah, that's a good one.
What are some of the key takeaways that stood out to you?
Well, the book really hammers home the importance of telling a compelling story.
Ah, the power of storytelling.
It's huge. Investors aren't just investing in your product. They're investing in you, your passion, your vision.
The human element.
Exactly. Create a narrative that grabs their attention, highlights the problem you're solving, shows them why your solution is unique.
Make them feel something.
Yes. Facts and figures are important, but it's the story that makes you memorable, sets you apart.
Got it.
And the book also talks about the importance of a clear, concise pitch deck.
Ah, the dread pitch deck.
Well, it doesn't have to be dreaded. It's about focusing on your key selling points, showing the market opportunity, and presenting your financials in a way that's easy to digest.
Right. Make it investor friendly.
Investors are busy people. They don't have time to decipher a complicated presentation, so keep it simple, highlight what matters.
So clarity, conciseness, and a good story.
Those are the pillars. And when it comes to actually delivering the pitch, practice, practice, practice.
Yeah, for sure.
Anticipate those tough questions and be ready to adjust on the fly. Think of it like a performance. Be confident, engaging, memorable.
It's your time to shine.
Exactly. Show them your passion, your energy, your belief in your vision.
What about things to avoid?
Yes, the pitfall.
Common mistakes that can kill a pitch.
Well, the book warns against overvaluing your business.
Right. Be realistic.
Exactly. Have a solid justification for your numbers. Investors can spot inflated valuations a mile away.
Honesty and transparency.
Always. And when it comes to due diligence, be prepared, organized, have all your documents ready, and be upfront about any challenges or risks you face. Don't try to hide things. Transparency builds trust.
It's a recurring theme.
It is. And remember, due diligence is not just a hurdle to clear. It's a chance to showcase your business and build that relationship with potential investors.
It's an opportunity.
Absolutely. One last thing from the book that really stuck with me. Choose the right investors.
Well, that's huge.
It's not just about the money. Find investors who share your values, who understand your vision, and who can bring more to the table than just capital. Do your research, talk to other entrepreneurs, make sure it's a good fit for both of you.
It's like any partnership. Compatibility is key.
Exactly. The wrong investor can create more problems than they solve, But the right investor can be an incredible asset. They can offer guidance, connections, support, all of that.
It's about finding your tribe, the people who believe in what you're doing.
Exactly. So we've covered a lot of ground here. Different funding options, investor relationships, the importance of a solid business plan, a compelling pitch.
It's a lot to digest.
It is. But the main takeaway is that there's no one right way to do this. The best funding strategy is the one that works for you. Your business goals, your risk tolerance, your values.
Finding your own path.
Exactly. And remember, funding is just one piece of the puzzle. The real magic happens when you combine passion, hard work, and a relentless pursuit of your goals.
Well said. So, to wrap things up, I want to leave you with this thought. Funding is important, but it's not everything.
Right.
Focus on building a fantastic business, one that solves a real problem, makes your customers happy, and has a positive impact on the world. The funding will follow.
Couldn't agree more. And remember, we're here to support you on your journey. Best of luck with everything.
That wraps up our deep dive into the world of funding a new business. We hope you found this helpful and inspiring.
We did too.
Until next time, keep learning, keep growing, and keep diving deep.